You know those headlines you see about some investment that promises a massive, almost overnight return? Well, that's the wild world of high-risk speculative investing. And today, we're going to break down exactly how it works and what it really means when you're talking about your money.
Okay, so let's just get right to the heart of it. The big question. Are these high-risk, high-reward plays actually worth it in the end? By the time we're done here, I think you're going to have a much clearer picture.
You know, to really get speculation, we first have to talk about what it's not. Most of us think of investing as this long-term game, right? You buy something, you hold it, and you're aiming for that slow and steady growth over years. Well, speculation basically throws that entire playbook out the window. It's all about short-term profit, and it loves the one thing that traditional investors usually try to avoid: volatility.
So what does it actually mean to play the speculator's game? Let's dive into the fundamentals.
At its core, you got to understand that speculation is really a bet. You're not just hoping for an asset to grow over time, you are banking on a fast and pretty big change in its value. So forget slow and steady wins the race. This is all about trying to profit from those big, dramatic market swings.
And this quote from our source material just nails the mindset. It says, "Speculators try to take advantage of short-term volatility in the market." See, this isn't a passive, set-it-and-forget-it strategy. No way. It's active, it's opportunistic, and it's all about getting the timing right.
So what makes these speculative assets tick? Well, first off, their prices are constantly moving. That's what fuels the whole thing. Second, because of all that movement, the potential rewards can be absolutely huge. And interestingly enough, for some investors, adding a small, really calculated speculative play can actually diversify their portfolio. It can act as a sort of hedge against their other, safer investments.
All right, enough theory for now. Let's look at a real-world example to see how this all plays out. First up, junk bonds. So in the bond market, you've kind of got two ends of the spectrum. On one side, you have these highly rated, super safe bonds. They're low risk, and they offer stable but, lower returns. And then on the other side, you have junk bonds. These are considered speculative. And why is that? It's because the risk of the company that issued them defaulting, well, it's just a whole lot higher.
So you might be asking, why on earth would anyone take on that extra risk? The answer is pretty simple: a higher payout. Investors demand to be paid back for taking a chance on something riskier, and that payback comes in the form of much higher interest rates.
Let's move on to our next example and see how this idea works in a totally different market: precious metals.
Things like gold and silver are classic speculative plays. Why? Because their prices are always in a state of constant fluctuation. They can go through some really significant ups and downs, both in the short term and even over the long haul. This simple chart really shows the two roads you can go down. If the market conditions swing in your favor, the value can appreciate, and boom, you've got a nice gain. But if the market turns against you, that value can decline. And if you have to sell then, you could easily end up with less than you started with. It is a pure bet on which way you think things are going to go. Okay, for our final example, we are stepping into one of the biggest and fastest moving markets on the entire planet: Forex trading. So, Forex trading, at its core, is just the act of buying and selling pairs of currencies. You're not just buying, say, US dollars. You're speculating on the constantly changing value relationship between the US dollar and maybe the euro. So how does this actually work? Well, it all starts with picking a currency pair. Then something happens: economic news, a change in interest rates, some political event, and it causes one currency's value to fall. When that happens, the other currency in the pair naturally rises by comparison. The speculator's entire job is to try and predict which way that relationship is going to move and place their bet accordingly. But, and this is a really big but, with this kind of fast-moving 24-hour market comes a very serious warning. The Commodity Futures Trading Commission has pointed out that a variety of recent scams have hinged around fraudsters approaching marks, offering these can't-miss coaching programs or investment deals in Forex. It is absolutely a space where you have to be incredibly careful. So, we've looked at bonds, we've looked at metals, we've looked at currencies. What's the big takeaway here? Let's bring it all together and talk about the risk and reward.
So what is the one common thread that ties all of this together? Whether you're talking about bonds or metals or currencies, the game is exactly the same: high risk, high reward. You are intentionally, purposefully stepping into uncertainty, all for the chance at a really significant gain. It's a trade-off, and it's a very conscious one.
And that brings us right back to where we started. But this time, the question is really for you to think about. What does this level of volatility mean to you personally? Is that potential reward actually worth the risk you know is there? At the end of the day, that is the fundamental calculation every single speculator has to make for themselves.